Hi there, Adrian here, mortgage broker based in Sydney. On this channel, we talk about all things lending, finance, and investments. On this video, I'm going to be doing a quick recap on where I'm up to because I haven't been posting some videos of late, and just give you an update on my life and what's been happening, because there's been a lot of things happening over the last couple of months that I haven't really updated everyone about. Now, not many people know that there is a second channel that I started, and this would have been about 18 to 24 months ago. And it was started at a time where I was putting some money in stocks. All right, so I have 250 subscribers over there, and I've got 95 subscribers on my channel on this one, based for Sydney mortgage broking. Now, I've been on quite a journey, and I haven't really been completely open on the other channel, so I thought I'd just post this video and then I'll put it on both channels to update everyone. So I've been on quite a bit of a journey regarding property in the last 18 months. So my first buy was December of 2020, and up until now, in the last week, it's been pretty busy. I've signed contracts and gotten them accepted on the other side for my 7th and my 8th investment property. Now, we're kind of at a point now where interest rates keep on going up, so my borrowing power is getting throttled. So I thought I would be able to get up to maybe in the realm of 10 or 11 before interest rates go up. Or I'd be able to get them done, the majority done in a main tier bank, and then maybe 2, 3 or 4 done in a mid-tier or a non-conforming bank. But my wife and I, we've made the decision to just really stop. We've gotten what we want done. And really the extra borrowing power that I could have gotten before rates went up 3-4 months ago has kind of eroded away with rates going up over, nearly 1.5%. So, those mid-tier banks, I was looking at anything in the high 3s to the low 4s, have now turned into kind of a mid 5.5%. And, as of next month and the month after, it's going to go more towards a 6, maybe a 6.5% for the mid-tier and the non-conforming banks. So that's really like a big decider on why we've chosen not to continue pushing. We could, we've got the borrowing power to do it and the deposits to make it happen, but I think, a lot of people, they're on a plan to get to a certain level and a certain amount of properties. But at the end of the day, I just look at the amount of asset base that I'm sitting on at the moment and the rental that I can get from that asset base, and I'm very comfortable that we've achieved what we have achieved, which is great. Now, we are moving. We're making, Maria and I, my wife and I, we actually are making the decision to leave our rental in South Sydney, and we're moving up to Brisbane, which is going to be a very good time to start a family and start building a life together with family in Brisbane, because we've got the parents moving up there and my sister's up there. So have family close. So as of next month, we will be moving up there, which is great. I'll be anywhere around kind of south of Brisbane, but within a year, Maria and I were trying to make the decision to move somewhere in the eastern suburbs in the south area. So that's kind of what's going to happen over the next 12 to 18 months. And really looking back, we've gotten kind of to the point where we're at 8 investment properties now, and we're sitting on an asset base, once we put all the granny flats in, of anywhere between 4 to 4.5 million total. And we're, once we move into the owner occupied that we've got as of this year, and then we'll move out of that to the eastern suburbs, we'll be sitting on anywhere around kind of that 240 to 260,000 in rent coming in per year, and that will just be based on all the investment properties. So we are in a really big build phase at the moment as well. So what's happening is I've got 4 properties that I need to put granny flats on, so I will be putting them on. I've got 3 that are going in by the end of this year, and then I've got a 4th one that's going in as of February of next year. and you've got to kind of time it with the leases that are up and the purchases that we've made, and when their leases come up and things like that. So we've kind of had to align everything with that. And yeah, we're in a situation where once all the granny flats go in, we'll be sitting on anywhere between about, say, 7 to 7.5% rental yields. So I'm not really worried about all these interest rate rises, and I don't really think main tier banks will get anywhere close to that, because if you think about it, most of the debt that I've got is investment debt, so I can claim the interest expense, I can claim the costs on the properties, on my investment properties. Even if there is a shortfall, I've got negative gearing. So if there's a shortfall on the properties that I've got on a per yearly basis, I can claim half of that back on my tax as negative gearing, so the following year. So don't take any of this as financial advice. Speak with your accountants and things like that. But I've already modelled it. Even if rates went up to, say, 12%, I can still cover the shortfall for the year and then claim it back on a negative gearing, get half of my costs credited back to me, because Maria and I were in the top tax bracket. All right, so really we built a portfolio that's pretty much indestructible. And if rates go up past what my yields are on my rental properties, I think a lot of other people are going to be in a lot more strife than anywhere close to what I will be. So I'm quite happy with the total position that we've got. So we've gotten up to a position where we're at kind of 8 investment properties now. 4 of them will have granny flats on the back of them. I'll have 2 units in there, and I'll have one dual key as well that are sitting on very good yields. So overall, it's a very well balanced portfolio, and if rates start coming back down, say in the next, say, 12 to 24 months, personally I think that they will, because what's going to happen is, in my personal view, I see rates going up. And then really we're going to get to a point maybe 1% higher than what we're currently at, where a lot of people are going to go into stress. You're going to see businesses that haven't recovered from COVID have a lot of problems. You're going to see record debt levels at the government levels. They're going to have some problems. And then there's going to be like a 3 or 6 month area where the RBA and the government are going to be looking at these stats coming out. And do they want to go into a really heavy depression and ruin the market, or do they want to save it by printing money and dropping rates again? And my thoughts are, they're going to print money and they're going to drop rates again. So we're going through, in my view, like a 12 to 24 month period where rates are going to come back down. And if they do, I'll be there to load up again. So I might get maybe 2, 3 or 4 more investment properties with granny flats on the back. All right, so that's my personal view and what I'm thinking is going to happen over the next 1 to 2 years. And now that we've got in a position where, 1, we've got enough property so it'll compound for life. 2, we've got enough rental that covers everything, even on really high rental yields and higher interest rates. We've got everything covered there. 3, we're going to probably start going down the stocks and ETFs and investments route. So I'll be maybe in the next kind of 1 to 2 years, because we're based in Australia, the super system allows us to do 5 years backdated super contributions at, say, 25 grand or 27.5 grand a year. So we can do that each. So 1 year we might chuck 250, 300 grand into super, start an SMSF, and then link it to maybe like a ComSec or something, and then I'll just manage that. We can do that. I can just start putting some money into ETFs like, VAS that covers the Australian market, or IVV that covers the American market, or, WAM ETF. So that's really good for dividend yields, or WAX, that's really good for dividend yields as well. They really focus on the industrial companies. So I might just start doing that, because we're at a point now where the business is going well, the income's there, we've built the base and the assets, and now, I'm mid-30s and my wife's, late 20s, and do we really need to push too much more in life? We're at a stage now where we just invest every month and then it compounds, and there's a whole lot of excess per month to be allocated. So that's where we're at in life, and really it's come really quickly. I'll be honest with you, and looking back on where we've come from and the struggle that we've done to get here. So, we haven't done everything the same way that life tells you to do things. So, we haven't gone out and gotten these flashy cars, even though Maria and I, we could have afforded Range Rovers and car finance, and we could have gotten a house in my parents' area where they were going to retire, $2 to $2.5 million. We could have afforded that, but we chose to do things in the opposite way that life tells you to do it. So we had an affordable unit. We didn't get anything nice. We didn't have children yet, and we rent vested. So we did that for kind of 18 to 24 months, but we've been in the unit for the last 4 to 5 years, and really I can say that my business thrived in this kind of environment where there wasn't a lot of stress on me. And really every amount of debt that we've got against ourselves currently is investment debt. So you claim the interest, you claim the property expenses, you've got a really high rental yield, helps you increase your borrowing power with the banks, everything that the benefit. And really some people say, but you're paying a whole lot of tax, but it's a really low stress way of making investments. And you can do it two ways. You can really, go through your large regional centers, buy houses that are 200 to 300 grand. Hopefully you don't buy in mining towns and do it that way. Or you can just do it very simply like I've done it. So if you can't get the yield in a main city, you just buy houses with good yields and then put a granny flat on the back to create your total yield. It's a very basic way of doing things. So I've got a lot of property based in Brisbane at the moment, so I will get hit with a decent amount of land tax, and then when properties go through the next cycle and I hope rates drop, I'll hopefully buy maybe 2, 3 or 4 in Perth, and I'll put a granny flat on there. And if the Adelaide market softens a bit or isn't as hot, I'll do 2, 3 or 4 there as well. So I'll split things up per state. But I'm not really one of those investors that likes going out into these regional areas, especially northeast Queensland, because you got a lot of flood and cyclone risks and things like that. So yeah, you can dodge it and you can mitigate it and you can buy in the better areas of towns and things, but I just like buying in a main city, having a great rental yield, and then just holding it for life. So that's where we're at currently. We will be going up from Sydney to Brisbane in the next month. So we're going to be up there. So I'm going to be doing a lot more footage on me putting the granny flats in and talking about metrics on what I've done on certain properties, and really just talk about that, because I think a lot of people, they see these kind of guys that have like 30, 40, 50, 100 properties, which is great, but they've done that really in the last 10 years. Okay, so they've done it under different lending conditions. I've done it all under the current lending conditions. All right, and even on my last year's tax return combined with my wife, we weren't even in the top 20% quintile of household incomes, which is 280,000. Okay, so we weren't in the top household income bracket, and we managed to get to 7 investment properties before we got capped. Okay, obviously my income's gone up on the current tax return, but we can show that it is achievable in the current market, because that's what I've done. And I built a large team, so I've got a good accountant, I've got a good buyer's agent that I use, I've got a good property manager that manages my properties, I've got an insurance broker that manages all my insurances for all the properties. So we've done everything right to outsource as much as we can. And really, you don't really see many guys that are, mid-30s that are really talking about financial freedom, but not just financial freedom. They've shown you that they've done it in the current environment. So, look, if I wanted to reel back on my business right now, I could. And we're already starting that. She's worked up until today, up until next month, and then she's actually stay at home. So hopefully we're having kids soon. So she's just going to be setting up the house and doing that. She doesn't need to work anymore. Now, obviously, once we have kids, that'll be great. She can be with the kids. And as far as I'm concerned, I'm just putting more money into property that generates a good rental yield, and then I'll buy dividend stocks that again have a good rental yield. And in Australia, we have franking credits, which is amazing. It means that the company pays the tax on the dividend before they give it to me. So it pays at the company tax rate, so 30%. So, if I allocate that to myself, I'm on the 48% bracket. So obviously I've got to pay 18% tax on that. But if I go ahead and I set up a company trust and I do all of my buying under that company trust, I'm in a position where all of my investments will be compounded at the company tax rate. And if those dollars stay in the trust and they never touch me, okay, they never get hit with the 48.5%. So I can just compound all of my investments in that trust for life at the 30% tax rate. Okay, so that's a way to compound my wealth. All right, so that's just some of the things that we're doing at the moment. That's an update where we're at in life. And really, I ask myself, do I feel like I've made it? And it's a little bit surreal because you struggle and you fight and you plan and you execute as much as you can, and there's always the next thing. But I feel like we're at that point now where we can really just slow down and compound, and we're at that stage now where the numbers get pretty stupid if I do this over the next 5, 10, 15 years, and I'm only 34 right now. So even though the numbers aren't where we exactly want it, I know what I've got earning in the business, and I know what we've got earning from the rent, and I know what I could do as far as the super with maybe a 250, 300 grand lump sum into there, and I know what the compounded amount, if I put 2 lots of contributions at 27.5 grand per year for the next 30 years, I know that will end up being stupid money, and I know that if I put money into stocks regularly for the next 5, 10, 15 years, that'll turn into stupid money. And really, we're at a point now where I can essentially say that there's not a whole lot of risk that I'm not going to get to those kind of numbers, and I'm not even overstating investment goals or the amount that I can put in. Like right now, if we wanted to, we're at the stage now where in excess of 200 grand can just be placed into stocks every year, and that's right now. And then if I buy another kind of 2, 3, 4 properties over the next property cycle, when rates come back down and the borrowing power goes up, then I'll be in another cycle where my rent's going to go from 250 up to 350, maybe 400. So there's 400 grand worth of rent, and obviously I've got debt associated with that. And then every property, every purchase that I make as far as stocks go, a lot of the stocks and ETFs that I'm looking at are sitting at anywhere from a 6 to 8 to 10% dividend yield with a fully franked dividend as well. So again, every dollar that you're putting in, it's compounding at about a 10% rate. So even if you say, nah, let's not use that, let's use a 7% rate, it's still, the numbers get pretty stupid pretty quick. So right now we're just in conservation mode. We're just in that mode where we're like, okay, we built it, now we can't destroy it, now we don't want to blow up. So really the answer for some people might be pay down the debt. But the answer for me is, why would I do that in a 15% plus inflationary environment? If my rate's 3 to 5%, but inflation's 15%, why would I pay off any of that debt until inflation goes? So, it erodes investment debt. So the only thing that I think that is good is to build up income in the form of dividends and franking credits. And every dollar that I put in, I'm getting between kind of a 7, 8 or 9 or 10% dividend yield. So I just do that for the next kind of 5 to 7 years, and then my business income's replaced fully, and then I can do whatever I want. So that's kind of where we're at the moment, and it's a little bit, I'll be honest with you, it's a little bit surreal talking about it, because you fight, you scratch, you bleed, you work 60-hour weeks, you go through so much risk with starting a business and building it up. You know, you leave the corporate world, the salaries where they only want to pay you 60, 70, 80 grand, they're never giving you the promotion. And then you get to these kind of numbers, and it's almost like, even if I got into management with the companies that I was trying to get promotions in, the numbers aren't even close to where we're at the moment. And even if I was on those kind of numbers, those, you know, maybe 100 to 120, in the current environment, that doesn't mean a whole lot. I mean, if you're in Australia, you're in Sydney, you're in Melbourne, which we are, prices are so high for property, prices are so high for food, utilities, everything's gone up. All right, so even if you're on those kind of incomes and you're on joint incomes with your wife or your partner, if you're not investing heavily to exit the system, that money gets eroded so quickly in living expenses, in mortgages, in holidays, everything like that. So Maria and I just chose to, you know, operate our lives in a very different way, that over that kind of period of time, we've exited the matrix. It's gone. So look, I'm going to be doing a lot more content on these kind of topics and being just very open with what I'm doing and how I'm doing it. A lot more videos once I'm up in Brisbane on site, showing you the properties that I've got on, what the metrics were, what the story was behind the purchase. But I just want to, share a lot of, what we're doing and why. And I find that people that get up to my kind of, and I won't even say level, I just think so many people, they can't exit the matrix. They can't. They work until they die, or they work until they're 65 or 70, and then that's life. And then they retire. All right? And now, I'm there. Do I want to retire? The answer is no. Okay, but do I want the option to do what I want when I want? Yeah, absolutely. So I might, I might hire 1 or 2 more staff members in my business, so then I do everything up front and I deal with customers, but they take everything off the back end, and I won't care about the extra cost because it's all paid for in the investments. So I might do that. That's a stress-free way to slowly reduce my income slightly because it's more expenses, but from a stress point of view and the ability to do this for life point of view, that might be a way that I do things. I might, take 1 day off a week. I might go and play golf with my dad on Friday. Might want to do that. I might want to start buying some businesses. I might buy out an accounting firm, buy a fin planning firm, join them all together with my mortgage broking business. I could do that. There's a whole lot of options that I could potentially take, because if I do this consistently and I just compound it for the next 5 to 10 years, the numbers get stupid very quickly, like stupid on a compound calculator, and that's what we've been doing for the last kind of 18, 24 months anyway. So we're kind of at the point now where we're capped in the lending, so we've got to start diversifying into shares, ETFs. Overseas markets here, put a bunch into super every year after that, put 55 grand into super for both Maria and I, and I've looked at the 55 grand for the next 30 years until I retire, off a starting balance of say 300 to 400,000, and I put that into a compound calculator, and even that, the numbers are stupid. Like it's almost like you get to a point where it's not like money is meaningless, but money gives you access to certain things, and then that's it. And once you go over a certain threshold, that's pretty much it. A lot of options in life are there, and you can do things like an international trip per year. I can take my parents and my overseas, my Filipino parents, for my wife. They can come with us with the kids. It's all paid for per year. Or if I want to go down to the Australian Open tennis for 3 days, hire a hotel, it's paid for. If I want to go down and watch the Grand Prix in Melbourne once a year, it's paid for. So if I want to, just get a box at the NRL and spend a couple of $100 or $300 for a box seat or something like that, not really care too much about it, it's paid for. So I find flaunting wealth isn't really the right thing. It's more like once you get over a certain level, it turns into access. It turns into, some people say power, but I wouldn't say that. I would say more access, because I'm not making the decision based on the price anymore. I'm doing it based on the lifestyle, or making my wife Maria happy, things like that, or making sure we've got the money where if we have triplets, the money's there, things like that. So I found, over time, my concept of money has changed quite a bit. All right, so we'll finish the video here. That's kind of where we're at. That's the update. There has been big changes in our life, and we have done it in a very systemized and dedicated way, where some people will look at us and they'll say we're lucky. But really, you can't be lucky and just fall into this. There was no help by family or friends. We haven't lived with them in a long time. My parents are semi-wealthy, but they've never given me money. They've never given me access to jobs or anything like that. It's just purely out of our sweat, blood and tears that we've been able to create this. And I just want to show that it is achievable in the current environment, what we're doing and how we're doing it. So yeah, we're going to live up in one of our investment properties while we put the granny flat on the back in Brisbane. And then once we've done that, we live in it for 12 months to get a stamp duty concession for, we saved like $8,000 just by living in one of the properties for 12 months. Then we'll move over to, the eastern suburbs after kind of 12 months and living in one of the properties. So yeah, hopefully this is just a good guide and update on where Maria and I are at. We're still driving the old cars. We're still driving the Suzuki Swift. We're driving a Toyota Camry. Both of those cars are in 2007 and 2005. So we still haven't even upgraded our cars yet. That'll happen in kind of the next 18 months, give or take, after we move out of the 12-month property. All right, so that's kind of where we're at. That's what we're doing. We've got the big move happening next month, and I'll just be doing some updates on, what we've done, how we've done it. I'll show you the stats. I want to do a lot more videos on site and just show you, where we're up to and how and what we're doing. All right, we might get Maria on the channel a little bit. And yeah, we're going to start doing some home renovations, just small cosmetic work like paint, taking up carpet, polishing floorboards, things like that, just very minor things. And I'll show you a bunch of videos on how we're doing it and why. All right, so hope that this video just gives you a good update on where we're at and what we're doing, and we'll keep updating you in the future. All right, have a great day. Bye.